Howdy, Jacob here. Today we're looking at Enerplus Corporation in the oil, gas, and consumable fuels industry. Roughly the same 3.5, $3.6 billion market cap to enterprise value. Growth is kind of all over, or revenue is all over the place, where it has dropped 51%, but has also gained 86% year over year. So pretty wild. But the last 3 years, everything looks fantastic, where operating margin is over 30%, gross margin high 30s, and then return on invested capital 30%. So pretty substantial. Been around since 1986, founded in Canada. Balance sheet shows 67 million cash on hand with about 186 million in short-term and long-term liabilities. Not bad. It just depends on their cash flow. Okay, so yeah, definitely not a bad balance sheet, where they have 186 million short-term and long-term debt, and last year alone, 936 million free cash flow produced. So the use of cash in the most recent 2 years, well, big acquisition and then some devastations, but there is quite a bit of share repurchases. I would say in aggregate, a lot more debt pay down than debt issuance, and then their dividend that is 1.5% yield pays out very low ratio to their 5-year average. If the 5-year average is, let's say, $700 million, they're paying out 1/14 of that. So under 10%, 5-year average payout, pretty amazing there. From a dividend standpoint, it's pretty safe. And then they have been buying back a lot of shares here. So we should be putting that into our assumptions. So I think I'm ready to make some. So let's go on the revenue side. I don't know how much growth there's going to be. I'll probably just, anytime there's a wildly volatile company, that has some growth, you would think. I usually just do somewhat in line with inflation for the revenue growth, and then a terminal PE and free cash flow in line with that. And then for the margins, I'll probably do an average because it's so substantially higher. Oh my God, that free cash flow is so much higher than earnings. Let's see, let's do 20 and 35. Pretty crazy, but I feel like I just want to check already what I feel like before even going into it, the P and price of free cash flow is just not realistic. So on an average basis, P definitely under 10. Price of free cash flow is very low, very low. Okay, so I might dwindle this down a little bit, do 2% and then 10 on the P price free cash flow. So I literally just looked at their historical P and price free cash flow, and I'm going to assume that, hey, the growth opportunities will probably be similar to what it's been the last 8 years for the next 7 years or so. And so let's do relatively in line with their average that they're showing. And then we get to, let's say they buy back 5% of shares, say 4%, because that's 4% would be about 140 million. Yeah, so that's saying that this other takes up a bit of cash, and I'm saying that although their dividend will pay out, let's say 10%, common stock is going to pay out 40 to 50%. I'm giving them an opportunity to reinvest back into themselves with this massive return on invested capital, and also to pay down a little debt. So that's the outcome there. So honestly, get to a price that's pretty close. I'm going to probably do some more research on this in the next couple of weeks. I still have a bit of companies that I have to look to do an analysis on before I get to this one, but definitely in the next couple of weeks I'll be reviewing it. So hopefully you enjoyed the video and have a great rest of your day. Thank you.